Secured loans are a popular way for homeowners to raise money, and there's no denying that getting one can be a great way to streamline your finances. Debt consolidation, home improvement financing, even paying for a new car, secured loans can be used for all of these. However, like any financial settlement, it is wise to take your time when deciding whether to proceed. After all, with a secured loan, you can bet on your home for a successful outcome. So what are the things you should keep in mind before finalizing your application? Firstly, as mentioned, it is an unavoidable fact that taking a secured home loan can potentially put your home at risk. If you default on your loan, the lender can apply for foreclosure on your property, evict you, and then sell it for less than market value to pay off the loan. Scary, huh? This is of course a fairly rare outcome, and most lenders are happy to work with you if you run into problems using recovery as a last resort, but you should consider it carefully before taking out a loan. Must do, especially if you have secured existing unsecured loans. Though debt consolidation. The second problem with secured loans is that they are very high volume, and are repayable over a very long period. This means that the interest you will pay for the entire term may be much higher than you expect. Even with a low APR, secured loans are not necessarily a cheap option. Third, if you use a secured loan to pay off some existing unsecured debt, you may get the illusion that your debt level has dropped. Then there is always the temptation to use your credit cards etc. to make new loans, so now you have secured and unsecured debt hanging over your head and you will be in a worse position than before. The fourth problem with secured loans is that you will naturally take the equity out of your home. In other words, the value of your home and the amount of the loan secured in it will be very close. Property prices today are at record highs and many experts are predicting a fall in the near future, noting that you may be in an uncomfortable position to pay more than your home's value, that is, you fall into negative equity. The fifth issue we will cover relates to the removal of equity from your home. If you want to take advantage of a refinance offer to lower your mortgage costs in the future, it helps to have as much equity available as possible to secure the best deal. A secured loan now can hurt your chances of a remortgage in the future. So all this has stopped you from getting a secured loan? This should not be done, as you can still benefit greatly from the financial restructuring that will allow you to do so. However, this is a big decision, and this is why you need to be aware of the potential issues first, so that your decision can be communicated as best as possible.